computer. All right, I'm going to assume we're live. Michael, this has been a crazy week. It's ending really, really positive. We just had a vote with all of our Terrace Hill investors to do something really unique. Never thought would happen. I mean, we love it. We bought a rate cap when we closed on this deal back in 2021. And the rate cap was an insurance policy for rates going up. They would pay the difference based on our mortgage payment for that property. It's a $27 million property when we bought it, worth $33 million now, but they're going to pay the difference of our mortgage and wherever increasing rates took our mortgage payment to. We just closed a refi a few months ago on that property to a fixed rate, and we're really excited about that. And the most exciting thing is, A, we got a little bit of cash back on the refi, which is not common in this interest rate environment. B, we no longer needed the rate cap. We sold it because rate cap companies prefer you to sell it back to them. They don't want to keep paying out for years and years to come. And we chose to sell it because, geez, it's a huge profit to take advantage of. And if rates went down, that profit would go down. So we made $1.3 million by selling the rate cap, got another $600,000 back through the refi. And it's really, really fun and satisfying to be able to call our investors to a meeting and say, we'd like you to vote. Do you want, after we put aside some money for repairs, do you guys want to take that money and have it redistributed back to you investors as a return of capital? Or would you rather just let it sit in the bank account? Obviously, everyone's pretty damn excited to take a return of capital and have that money come back to them. And it was very unexpected and a really fun surprise. So today's call was really fun after a lot of stress and craziness with F4. We're closing that deal, but Michael, I'm feeling pretty good about the Terrace Hill situation, and honestly, closing the F4 refi as well, feeling really good about that.
I don't know of very few, if any, people in the apartment space now that are selling rate caps and giving money back on refis. It's very, like you said, very satisfying, and good job to Lyndon and the team to do it properly and put us in that position to do it. It was a huge windfall. And I think everybody's pretty happy about that, as they should be. So it's a wonderful asset.
Yeah, and I think we deserve a shout out to Tien for finding the Terrace Hill deal, Lyndon and Tien and myself and Steve and you for raising the money, getting it under contract, and closing on that deal. And now closing on a refi and being in a really, really positive situation for years and years to come on that property. And our partners are really great. They work their butts off to get the refi done, to put us in a really good situation. Betty Jo's helping manage that. Lorraine and her team at FPI do an amazing job for us. They now manage Desert Peaks, which is setting records every month for rent collections. So it's really nice to have such a massively positive situation in an environment. And I want to remind our investors how crazy this environment is. We have multiple contemporaries, people we know, bigger than us, more experienced than us, losing deals to the bank right now. $250 million portfolio just got taken back by the bank in Houston. Lots of small properties going back to the banks, big properties going back to the banks right now. It's a really scary time, but also really positive time if you planned well, if your deal had wiggle room. Thank goodness F4 had as much wiggle room as it did when we bought it, and that's why we bought it, because now we're closing on a refi today, probably closing right now as we speak, that isn't optimal. I mean, we wanted to cash out. We thought we were going to cash out quite a bit on the refi, moved heaven and earth to get it done sooner than later, or excuse me, get it done in 18 months rather than 3 years. And still absolutely not optimal, but positive and still going to generate some great income on that property. And when it sells, it'll be a really great win for our team and for our investors, which is most important. So Michael, you've got some really good points you wanted to talk about. Terrace Hill is great. We're super excited about extra money in Terrace Hill, but I know all of our investors really wondering about the situation in F4. And so what we wanted to do is break it down a little bit deeper in detail of why we had to refi 18 months early, and why we're so excited and relieved that we got it done. So I wanted you to start with kind of your view. You've got $1 million in F4. You've got over 14 million in these other deals. But Michael, give us a $1 million investor perspective of, and you're also a general partner, decision maker. What happened with F4 and why are you so relieved and happy about the situation we're in now?
Well, up until 4 days ago, I had $1 million into it.
Right.
Now I
Sorry.
have $1,150,000 into it. Why?
Well, hold on. No, you're wrong. You have that plus your portion of the money that the GP put in, which was 445,000. So I don't remember your exact percentage of that. So you're probably over 1.2 at this point into the deal.
Yeah. So it's been quite painful the last year and a half to acquire this property, and then right at the beginning of starting to renovate it, noticing that rates are jumping. Nobody 18 months ago, and people can throw stones all they want and second guess and be in the rearview mirror. That's great, no problem. But I want you to imagine what you would do differently than what we had done. You are buying a building, 187 units. The lender would not lend you a regular loan. It had to be floating money, which I was very much against and very, very concerned about. And of course, reminded by my 30-year-old, 28-year-old lender that LIBOR has never gone up in 30 or 40 years. I was well aware of that, but things do happen. Well, now you're into it for 3-4 months in the deal, you're starting to renovate, and all of a sudden you're starting to see major jumps in the 10-year bond. And all of a sudden we go, holy, you know what? We better really accelerate our plan by double. Now, we took a risk in doing that, because in doing that, and Samuel, correct me if I'm wrong, we chose to evict everybody we could at the same time as do the entire renovation in half the time.
Can I pause you?
Yeah.
We didn't actually evict anyone. We just didn't renew their rents unless they wanted to pay market rent, because it was about 40% under rented. So I hate saying evict, because we actually didn't have to evict anyone. We just moved them into either already remodeled units in F1 and 3, or allowed them to find something else that was affordable. Because, and again, this is why F4 was such an amazing purchase. They were paying $400, $500, $600 a month in a market that really demanded 11, 12, 13, 1400 a month.
Right.
And so we simply did non-renewals and we didn't evict anyone. We did give them the chance to stay at a market rate though.
Right.
But anybody that didn't want to, you're right, we had to get them out of there so we could remodel.
So imagine you're in a boat and there's a hole in the boat. And that hole is the income you're not getting from the tenants. While there's a hole in the boat is on fire. Why is it on fire? Because rates are going through the roof. I would like any person to text me or call me and tell me what they would have done differently. So that takes us to today. We have basically a brand new building. 180 out of the 187 units are completely renovated. We have a 6.5% loan that we're going into. First 2 years are interest only, or IO as we call it, meaning we're only paying the interest, which is great. Our payments will go from $94,000 a month down to about $65,000 a month. So we're going to be saving money there. But guess what? We also, at the last minute, had to prepay the school board tax, which is about $17,000 a month, and other taxes and money we had to put in other things. So our
school board is real estate taxes, correct?
Real estate taxes, that's right. So bottom line is this, and Samuel, correct me if I'm off by a little bit. We're going to be banking that cash flow, that beautiful cash flow coming in, to about probably 40 to 60,000 a month. We are not going to distribute until we have saved probably another $500,000 to replenish what we didn't think we'd have to pay out on this back end of the closing, because there's an extra $500,000 they forced us to do, letting us know this 48 hours before we close. We thought we'd have $450 that we'd have to close. Turns out we have $950. So we're going to cash flow crazily, beautifully, and we're going to just set that aside every month until we have what we need, and then start the distributions. And again, I would defy anybody, respectfully, to call or text me and tell me what they would have done differently in this situation. I would tell you, after doing this for 40 years, most operators would have lost this property by now.
Hey, Michael, can I make a point?
Absolutely.
You're 100% right. We turned down a lot of deals that didn't have the wiggle room, and we almost made this deal undoable by adding so much, being so conservative. So we recession tested the property. Then we added $500,000 to the raise just to sit there in the bank account, because we thought we had enough money, but we knew inflation was going crazy. Supply chain issues were going crazy. Rates were going to come up eventually. You and I said, you know what? $500,000 is a lot of money. That reduces people's returns, but let's still raise it. We can't do this deal unless it can
Yeah.
have that rainy day fund. And guess what? We used every penny, and then we threw in an extra $445,000 of our own money, and prices went up. Labor went way up. Materials went way up. Utilities, gas went way up. Real estate taxes ended up being way higher, and we're fighting that in a huge way. And so at every turn on this deal, we have been conservative, and that is the only reason we're in a positive situation. And I want that to be very, very clear, guys. I've never lost money in an investment, and this one was really rough. Within a few months of us closing on this deal, rates skyrocketed, supply chain issues manifested themselves, inflation went absolutely nuts, and we had a huge amount to do in a very short time. So what we did is we made the choice, hey, instead of cash flowing pretty good on this property, doing 5 units a month, and that was the plan, five remodels a month for 3 years, that would have maintained good cash flow, and that would have let us not dip into the 500,000 or the extra 445,000 or the extra 310,000 that we threw in ourselves. That's out of our pockets. What we did is we had to speed up. Velocity was absolutely the answer. We had to speed up that remodel because we could not refi with vacant units, and we could not refi at the lower net operating income amount. The bank, in order to give us a good refi, wanted to see the units remodeled and rented at the higher amount. So we did that. We are today 95% occupied. We
Yeah.
did it. And we did it 18 months sooner than we had planned. So we had to spend a lot of extra money out of that $500,000 reserve in order to expedite the remodel. But rates were going up so high, so fast. That was the only option. The only option still available to us. When we bought the deal, it was not needed. Rates were at like 3%.
Yeah, we had a limited partner this morning ask me, good legitimate question. Well, why did you guys speed up? Well, imagine we had taken our time and stuck to the plan, initial plan, before everything had changed, and just did 5 units. Well, we would have been caught in a trap of LIBOR continuing to rise.
The debt service, our mortgage
Debt
payment
service
is going up.
Debt service would have continued to kill us. And imagine trying to refinance another 6-12 months from now. It was not tenable, not tenable. And I've been doing this a long time. I can see around some corners. This is something that's never happened in modern recorded financial history, ever, where rates are double or triple, like in our case with LIBOR, tripled within 18 months. That's never happened in the last 50, 70 years beyond that I know of. I know no one, old timers that have ever told me, and I've looked it up a million times, never happened. So I'm just grateful that today we're going to close 6.5%. If we let the rate lock lapse, it'd be 7.1%. We'd still cash flow, but not as much. So it should be, we have a nice clear waters should be on this property from here on out.
Yeah, and you know, we're being conservative again. That's why we're not distributing till at least after the first of the year, because that's what saved us. And so I want to say that in a different way. What has saved us on this property every time is being conservative. Michael, you and I decided to increase the capital call. As painful as that was, we said, let's raise 1.4 because we think that gives us a nice buffer. And Lo and behold, a day before closing, the bank says, yeah, we want you to escrow all those extra items. We actually need 900,000 cash to close. Had we not done that, Michael, a few days ago, last Friday, we chose to do that. Had we not increased the capital call, we would be scrambling for extra cash. Had we not expedited the remodel, we would not be refining right now. We'd be out of cash. Had we not raised the extra money, we would have ran out of cash. Had we not put in our own funds, we would have been out of cash. And so at every turn, being conservative is what has saved us on this property. And now we'll be basically refied, building our cash flow, building our reserves again, and be able to distribute cash flow next year. We really shouldn't have been able to do that. The market really tried to have us fail at every turn, the market and the bank. And thank goodness we haven't. And so we're in a good positive situation there. So a few questions from a couple of investors I wanted to go over
Can I
really
just say
quick
one
on
thing?
F4.
I just want to say one thing. I've said this before. I just want to make sure we're on record again. You deserve 100% of the credit of the idea of raising that extra capital. I did not
Thank
think
you.
that was something that was needed to do. If we had not done what Sam suggested, we all agreed to, then we would have been in even a 10 times worse position. So it's incredibly, a lesson I learned is that better to be overcapitalized, not need it, and either keep it laying away or giving it back to the investors, than to be undercapitalized, which, as Sam knows so well, we're watching some very, very, very smart, talented people, including Starwood, including Blackstone, give properties back to the lender. Brookfield, the biggest of the big, plus all the people that Sam and I know personally, because these properties were either floating debt or not capitalized, which, by the way,
Undercapitalized, yeah.
every VC will tell you from Silicon Valley, the main problem with a lot of these companies that go bust is they're just undercapitalized. So that was a huge lesson for me as well.
Really appreciate that, Michael.
Just received the wire on F4.
Repeat that. Well, it's done.
The wires have been received on F4.
Oh, beautiful, beautiful. Yeah, Michael. No one was talking about overcapitalizing deals 3 years ago, 2 years ago.
Oh,
Everyone, and so, I got a little choked up there because this has been a rough deal. And I remember saying, and you agreed with me right off, no, guys, we got to have 500 to 750,000 extra for this deal. And what does that mean to our investors? Well, how much freaking easier is it to raise money when you promise, or not promise, when you show investors projected returns up here? Well, it's a lot freaking easier. It's way easier to raise money. And that's my job, is to raise money. So of course I want to make it look as sexy and profitable as possible. And so do you. That makes our job easier. However, for those of us that have a conscience and want to do the right thing, we said, hey, it's going to create a lot of extra work and convincing. We know this is a great deal. You and I have been there. We walked it. We love the deal. It's next to the Cleveland Clinic. But for our investors that don't know as much about it, or they're not as educated, it'd be really easy for us to project huge returns and just not raise the extra $500,000, because raising the extra $500,000 made the deal not look quite as sexy. But we were more concerned with being able to be profitable and not losing it to the bank. And so we gave real projections. And that was one of these investors' questions. And he said, hey, I thought you're projecting 6 to 10% cash flow. Yeah, had the market stayed the same and rates stayed the same, that's exactly what we were hoping for. Michael, who's now got over $1.2 million in the deal, absolutely was hoping for 6 to 10% cash flow. However, that was optimal case scenario. What reality is that inflation and rates and everything has gone way up, and we're excited to have the deal be a profitable deal, but minimal cash flow. And we'll get numbers and projections out to people as soon as we finish this refi and all the dust is settled. But we've always had multiple exit strategies. We knew we were buying next to the #2 hospital in the world. We knew that there's massive expansion projects with the neurological center and other expansion projects at the Cleveland Clinic. We haven't even seen the benefit of that yet. So yeah, we're hoping that if everything went as planned, which it did not, we'd be hitting 6 to 10% cash flow within the second, third, or fourth year. That didn't happen. So we're reevaluating. It's still a good investment. But no one was raising extra money back then. And Michael, that's the difference of us not losing this deal to the bank, is having extra cash, putting in our own cash, and really not running out of money before the refi was over or close to finished. And yeah, I appreciate you saying that. And now, you bet your ass, everyone in this industry is overcapitalizing their properties because they're watching their friends lose deals to the bank. Ferris Musa, highly respect him, Disrupt Equity. He and I had a conversation with Ben, his partner, and Lyndon in Houston a few months ago. They are overcapitalizing in huge amounts, and it makes the deal look less sexy because, you raise more money and returns are lower. However, they just don't want to lose a deal. They're like us. They never want to be in that situation. And that's why they're top operators, because they kind of live and breathe like we do with their deals. So anything to add to that?
Yeah, thank you. I also want to publicly say to everybody that stepped up when we asked them to, because I'll tell you something, 4 or 5 days ago, I was extremely concerned.
Yep.
I mean, we've had Sam, you and I have had our backs against the wall to close deals and done all sorts of crazy things the last couple of years, but this was a new one. I never had to go back to the well to recapitalize a deal to close a refi. This was a first.
Me neither.
I think a first for you. And so, we took a deep breath, gulped, and went back to the well and said, people, we're sorry to have to ask you this, but this is an emergency. We had to go to one of our dear friends and GPs on this deal, or TIC members in this deal, while he's vacationing in Hawaii, disrupt his entire vacation for 2 days.
Crazy.
With a beautiful wife and everybody else to pull off what was just pulled off today. And I'm going to give Sam credit again one more time. I only thought we needed to raise money just to close the deal based on the numbers we got, the 450 from the bank to close it. Well, guess what? Again, Sam and Jason and Jens said, no, just to play it safe, we better raise another $500,000, because you never know. If we hadn't done that, disaster.
Yes.
So again, Sam, thank you for doing that.
Appreciate it.
I went to the well as well as you did, and all the people that are watching this, that gave us the money to do it. Thank you.
Yep.
We really appreciate you stepping up. That is what true partnership is.
The definition of an educated, sophisticated investor. Rand, he has deals that he has never made money on, and he's telling me about his offices in Dallas. And so when I call Rand, we talk about the capital call. He's like, oh, okay, how much you need?
Yeah.
And because he's been on the calls, he's listened, he knows exactly what's going on with F4. We talk every week with Rand. He's educated. He's not oblivious to what's going on and then worried when he gets the call. He knows we're doing the right thing. He knows we made all the decisions for the best of the property. And that kind of brings me to the next question we got from one of our investors. He said, who and why was the decision made to accelerate the remodel? And he said, I don't recall a vote or any communication discussing this. So I'm like, well,
I'm laughing because we've made 400 of these recordings, but go ahead.
That's what I was about to say. We've sent out emails, and these recordings are all on YouTube and Facebook. And we've tried to explain it until we're blue in the face so that investors can be like Rand, who's also a board member, so they can be educated about what's going on. And I don't know how to give this more and make it more easy for investors to disseminate and to understand. I just had a thought, maybe I'll have these audios transcribed and sent out, because some people prefer to read. They don't prefer to listen and watch. However, you could just turn it on in your car while you're driving to work in the morning and listen to these in your car. So we're doing everything we possibly can to educate our investors, Michael, and I'm always willing to do more. So that's not a dumb question. It's just a question that surprises me, because we have talked about F4 for the last year, because it's been crazy. It's been a tough one. There's been so many moving parts. We don't need to take a vote as a GP, and that's why I syndicate deals, is I don't want to have ever have to rely on the limited partners to make a quick call. I want
Hey, Sam,
Michael and I to be able to make calls because we have the experience, the know-how, and the maturity to make sure these deals are profitable. And so I don't need a vote is the answer.
can I make it easy for you, Sam?
Yeah.
You're sitting on a United Airlines flight, crazy turbulence.
I love this
Imagine,
example.
could you imagine having the door to having no door to the cockpit and getting getting input from all the different passengers?
Well, yeah, if I'm the captain and
Yeah.
something happens, am I going to run back and ask the passengers what to do?
No,
Now,
no,
that's what a limited
that's when
partnership.
everybody dies.
Yeah, that's what a joint venture is. I don't do joint ventures. I want our general partnership to be experienced and professional enough to handle anything that comes up and be able to make those calls. There's a very few amount of situations that we need a vote on. One of the votes was to give our investors more of a bigger split on F4. Another vote was to give them their money back and allow us to pay ourselves a marginal fee for doing a good job on Terrace Hill. Anything changing returns, we do need a vote on. So for the person that asked that question, that's a really good question. We don't need a vote for operational decisions. We've put together a great team for each of these respective properties, and we don't need a vote, but we do try to educate you guys so you know at least what's going on. So please go back and watch the recordings. I made the decision while we're on this call, I'm going to have my assistants go ahead and have these all transcribed. Probably cost us a few $100 is all. And we'll send these out because I think it's great for those of you that want to read these, and we'll throw them in the portal so you guys can go back and read them as well. So next question, cannibalization of F1 and F4. He's talking about the lease up. And, anytime you're doing a massive remodel, there's going to be cannibalization or just, there's going to be a limited number of renters and a large portion of units that need to be rented. And so, yeah, F1 and F3 may have struggled a little bit. That's the risk we took by buying a large portfolio next door. But also there's a lot of benefit operationally. So maybe there's a few renters that chose to live in. We don't push anyone towards F4 over F1. We advertise everything and allow them to choose where they want to live. So that's first thing. Also, there's a huge operational benefit, and our expenses are much lower by sharing the cost of maintenance workers, advertising, and a number of other things, parking, snow plowing. We get a lot of big discounts, including that property management fee, by owning properties at scale in one neighborhood. And Michael, I would say maybe there's a little bit of cannibalization, or maybe F1 and F3 and F5 are struggling a little bit because of F4 need for renters or vice versa. But you were on the call with Jason. They don't push people towards properties that they don't want to live in. All of the properties are unique and units are different. They allow people to choose where they want to live in. So it may be that F4's got a huge need for renters, but those renters that are looking for units really want to live in F1, and we're going to allow them to do that.
Look, cannibalization on the short term is painful. No question about it. It's the price you pay, and it's already baked into the formula when we bought these properties. However, in the big picture, for scale purposes and efficiency purposes, you just said, and control purposes, let's have this conversation a year or two from now, where we are the second biggest landlord next to the second best hospital in the world, controlling that market.
Yeah. Okay, so really good. Yeah. And it's a huge benefit because now we can advertise at scale as well. Then we can own that market and control the rents a little bit more. We're now, I mean, really huge positives that I see far outweigh any negatives, especially now that the remodel's done on F4. F5 is another story. We'll finish that in the next year. The next question, Michael, I really want to touch on this so it's crystal clear. The terms of the refi is 6.5% fixed for 5 years. 2 years of that are interest only, and the proceeds went down. And so this question was, hey, why did everything change? You guys were telling me one thing and then a week later telling me another thing. Well, we'll revert that question back to the bank. Why were they telling us one thing and another thing? Well, rates went up And the bank decided from a few days to another, we're going to change this from a cash out refi where we're going to give you excess proceeds to give back to your investors and for operations, to a cash in refi where now you actually come to the table with money instead of being able to cash out. That'll happen within a few days. And we were trying to save it, trying to change their mind. They would not. So we thought we were in a good position. And everyone asked me, well, why didn't you ask the bank if they do that to you when you started this? Well, we did. They assured us they would not retrade us. That was one of my first questions. Gosh dang it.
Yeah,
But
Sam, have I been tough on our mortgage broker the last?
it's been awkward how tough you've been on them. To be honest, it's been cringeworthy a few times. But guess what? Every partnership needs someone that's going to push these banks. Banks don't care about us. They do not care about our investors. Michael Young cares for sure. And he's willing to push a little bit harder. I was willing to push harder in other areas with our, remodeling crew and the lease up crew.
Yeah, it's the golden rule. The golden rule is whoever has the gold makes the rules.
Yeah. Been crazy. So to answer that question, why it changed last minute, the bank changed things on us last minute. Why they did that? Because it cost them money to loan us money and rates went up. And because they can. They knew that we needed to refi, and we absolutely needed to refi. And so we did. So details of how we went from 400K to 950K, missing by over 2x what we needed. And so again, this is the bank deciding last minute. The numbers we had on last Friday were the numbers the bank gave us. The numbers we had a few days later were very different. They decided in finalizing the loan docs, you know what, we want you guys to escrow the real estate taxes, a bunch of repairs to the tune of $250,000, a bunch of other items for future expenses. And so just real estate taxes and repairs were $500,000. And so to answer that question, yeah, we had a set of a loan commitment, a set of docs from the bank. That's what we relayed to you guys, and then they changed. And so again,
which we would have paid per month going forward, but they just all wanted up front. So we're going to get that money back through cash flow, but we had to pay it all up front.
Yep. School board situation, how this was missed in the model. It wasn't missed in the model at all. We used a professional to basically look at what everyone else in this township is paying for real estate taxes. The school board being the largest and most important part of your real estate taxes. They gave us projections based on past sales, and they missed, and everyone else, our broker, our lender, and the tax professional were all off by about 40%. And so that's why these real estate taxes have been so high, is the school board assessed our property much higher than was expected. Of course, we projected in our model, we had taxes going up, and we thought we had projected correctly. And so again, that's something that we're fighting right now with the school board to lower those to a more reasonable amount, based on, traditionally what they have levied taxes at. They kind of doing their own thing, and they're maybe going to work with us, but we're working on that. Weather lesson learned, not really a lesson to be learned as much as making sure we had cash set aside. We had once in a 40-year storm on Christmas Eve, Michael, that destroyed a lot of buildings in the area completely. So there's a lot of apartments all over Cleveland and the whole Erie area that had to be completely vacated. So we felt very lucky. I guess lesson learned there, had we not repaired our roofs and not spent the money to maintain the roofs well, we probably would have lost our buildings, just like the other landlords in the area. So lesson learned, I guess there's a good lesson there. Maintain your roofs. These are 100-year-old buildings. You're never not going to have at least some serious repairs with a storm of that magnitude. But we did keep our roofs in really good shape, and that definitely paid off. Sheesh. I think that's most everything. Any other questions, Michael, that you feel has come up in the last week or so from investors that we need to touch on in this call?
No, I'll tell you something, Sam, and I want to say again, thank you to our investors. There's one or two people that have been quite unsatisfied with how F4 has been handled. All the rest of the people are on the calls, ask us directly. They're on the Zooms, and they're quite aware as things have gone on. This one person that asked these questions, which are good questions, are legitimate questions, but where they're coming from, the implication, I have not quite cared for, because it's suggested or implied either incompetence or hiding something. And again, I'll go back to the airline pilot or the captain of the ship. It's really easy while you're in the passenger seat to criticize and wonder what the heck's going on. That's fine. But we have been quite transparent as we've gone along. We've been a little less transparent the last few days because, frankly, we've been holding on by our teeth.
Well, it's not that we weren't transparent. We just couldn't get answers from the bank.
Well, yeah, or it was coming up so fast and it was so devastating what they're asking. We didn't have time to say, oh, by the way, this is going on, that's going on. We had to make decisions immediately, get the money raised to take care of this. And so I would just hope that these answers, all those questions, we've done the best we can, and that moving forward, those one or two people that have been a little bit unsatisfied really understand what the heck has gone on with this property, and we've made our best efforts to do what's right for these properties and for everybody's money.
Yeah, and I think the important thing is we don't mind being transparent. It's really part of our business model, actually. And so when I went into business, I said I want to be in business with people that are fun and competent, and also integrity is a huge deciding factor for me. And so, anytime an investor wants, they can look at the T12, T3, they can look at the P&L, they can look at the rent roll. And these investors ask for those items and they immediately get sent out. We don't have any problem with that at all. So I think that goes to your point of if you have any questions, we're happy to answer them. If you need transparency, it's there available to you at any time, because we have nothing to hide, and we pride ourselves in that. So feel free to reach out. Let's see here. Anyways, I think those most of the questions. As far as moving forward, that's the big question on F4. We're going to work on some projections, some expected distribution dates for next year, what that looks like. Right now we have a 5-year term on this loan, 2 years of interest only. And I really want to see where this neurological center and the expansion of the Cleveland Clinic ends up, and what positive gains we receive in the rent because of that. I expect it to be pretty good. And so my expectation for F4 is to start cash flowing, albeit much lower than we had hoped, start cash flowing and sending out distributions next year. And in the coming probably around year 3 from August 2023, so August 2026, around that time, start looking at a sale. We do have a prepayment penalty, years 1, 2, 3, and 4, but we'll see how much the value comes up. We are forcing appreciation by increasing cash flow. We'll see where rates go. And I'm really excited to hopefully have a situation kind of like Bradenton, Florida, kind of like Albuquerque, New Mexico, where on those deals, cash flow was rough the first 2 years. It really was. It was not fun, not optimal. But again, inflation, cost of labor and materials went way up. And both of those are under contract, looking to close in the next 30 days for an average 20% per year return for our investors. That's cumulative cash flow plus equity. And we love that. That's exciting. It hasn't been easy. And I'm hoping F4 does something similar. And I do believe F4 and our other Cleveland properties will follow suit and sell for great returns. And so that's the goal. In the next, anytime 1 to 3 years, anytime we can achieve a really great return on these properties, we will look at refining or selling. Whatever can get our investors' money back to them with a really good return is what the goal is. Michael, anything to add to that?
Yeah. These properties were purchased for cash flow, not to flip 2 or 3 years later. And I have $1.2 million in this one property. So if you don't think I'm not enjoying not getting $5,000 or $6,000 a month,
Yeah.
which I expected, think again, I would love to get $5,000 or $6,000 a month. But I also understand I'm looking at the bigger picture as to, in this last case, saving the damn property.
Yep.
From the bank, which I never thought in my wildest dreams I would even ever have to consider. But guess what? We were at extraordinary times. And we wanted to make sure we did everything possible to take that option off the table as fast as possible. And because I did what I had to do, and Sam and the team and all of our great investors listening, watching this right now, did what they had to do, not only to save the property, but we're going to be fine moving forward. Although, again, to my dismay and everybody else's, I'm not getting my $5,000 to $6,000 a month that I want to get for probably the next 6 months. But I know it's the right thing to do because we have to build back up our reserves to, again, never, ever have this threat happen again to this property or, of course, any other ones. So
That's the goal.
yeah,
And what's really fun, Michael, is to look at a very 10,000 foot view of our deals together. And I just want to go over that really quick, and then we can finish this call. I know you've got other things to do, but I want to make sure investors understand what's going on. Timber Hill, we're working with the senior partner to get that deal up to 90% occupied. It's under 80% still. It's struggling in a huge way. So we're working on getting a third-party manager in there. They fired the third-party manager earlier this year. The senior manager, our senior partner, took over. It's not working out with him. Had we been managing the property, Lyndon and Michael and I feel like we would be at 95% and doing very well. So we're very frustrated with that. And every other property we own, unless it's being remodeled, is well over 90% occupied. F4 is 95, Dallas, El Paso. So anyways, Timber Hill, we are working on either selling, refining, or holding it long-term because it's still a fantastic property and just getting the cash flow and the occupancy where it needs to be. We don't have a lot of control there because we're not the controlling partners. So we are pushing really, really hard though. Michael, Dallas, Meadow Creek, setting records every month for rent collections. There's nothing I can say to complain about that property. We're getting soccer goals installed, little soccer goals for the kids, a playground, set of playground equipment for the kids. Remodels pretty much done, almost 100%, few remaining units. But I think we only have one vacant unit on that property right now, Michael.
make it even easier. We're now $55,000 a month in a higher gross than we were when we bought the property 2 years ago. We
Yeah,
started out at 115. We're clocking at 170,000 this month.
amazing. Desert Peaks, same story. Although we're still remodeling quite a few units, setting records every month for rent collections on that property. And Terrace Hill, we already talked about, sending a bunch of money back to investors and doing very well, over 90% occupied on that property. Albuquerque, we are hopefully going to close in the next 7 to 10 days. And at the price we have it under contract for, if it closes, depending on where those final closing costs come out to be, about a 20% average annual return for those investors. Amazing. Bradenton, we just signed a contract on it a couple days ago. At that sales price, we will average right around a 23% average annual return for those investors. Amazing. We've got our Ogden deal that we are finishing the raise for. We left room for the people coming out of Florida and Albuquerque. That deal we are in the middle of remodeling, and we're hoping to hit close to about a 20% average annual return. That was an amazing opportunity. All of the Cleveland properties, they are lower cash flow and still in an amazing location. We still plan on hitting double-digit returns with those. Cincinnati's doing fantastic. The Atlanta deal with Robert's doing fantastic. Nothing to complain about there. So just want to, I guess, end with selling 2 properties for massive returns. The other 3 properties, which are kind of our crown jewels, Dallas, El Paso, and the other El Paso deal, setting records monthly for rent collections. And I'm really glad to be done with this refi and F4 and be able to move on.
Hallelujah.
Hallelujah. All right. Praise Oprah. Um, I'm going to go ahead and have this audio recording transcribed. It'll be on YouTube. It's on Facebook. Please text me or Michael with questions. Happy to answer questions for you guys. Thank you for your confidence. Thank you for your investments and your partnerships in these deals. And last thing I would say is we have some deals coming our way. Heard some whispers of some deals getting taken back by the banks, and we've been kind of holding our powder dry. I'm excited to see some properties come down the pike to us, and basically we're hoping for deals at a discount. People that are struggling, we're just conservative as us, didn't operate their properties how they should. Those are the type of properties that we're looking for currently, and we're excited to bring those to you possibly in the next 6 months to a year. Thanks, Michael. Appreciate you, man.
Appreciate you. See you next time.